Welcome to the Deep Dive. Today we're looking at a huge strategic shift in a sector you might, think of as a bit old school. We're doing an intensive look at the Q3 2025 earnings call for Brink's Co. That's ticker BCO.
That's right. And this call, it took place pre-market on November 5th, and it was critical. The market didn't just react, it really surged.
So our mission today is to get under the hood of those financial results and maybe more importantly, understand the big structural changes management is making, the very changes that cause that big positive market reaction. We're here to filter out the noise for you.
Exactly. Deliver the 3 or 4 most important insights you need to really understand where this company is headed.
Okay, let's unpack this, starting with the headline numbers. On the surface, it looked like a solid quarter. Revenue came in a little ahead of consensus at, $335 million?
Yep, that's it. A very healthy 6% year-over-year growth. And non-GAAP EPS was right on the money at $2.08, exactly what the street expected.
So those are fine results, but
yeah,
they don't really explain the 7.5% jump in the share price we saw right after.
They absolutely do not. The top and bottom lines were good, but the real story and what really got investors excited was the quality of their profitability and their cash conversion. This is where you can see the structural changes really paying off.
Okay, tell us about that jump in profitability.
So, adjusted EBITDA hit $253 million. That's a powerful 17% increase year over year.
Wow. Okay, so hold on. 6% revenue growth, but 17% EBITDA growth. That's some serious operating leverage.
That's the whole story right there. It suggests they're pulling costs out of the system much, much faster than they're growing the top line.
A huge difference. And where did that take their margins?
It drove their adjusted EBITDA margin to a record Q3 level of 19%. But what's really compelling, and you have to listen for this on the call, is that management said this was about 60 basis points above their own internal projections.
So they even beat their own expectations. Now, for you listening, 60 basis points is 0.6%. It sounds small, maybe. But over $1 billion revenue base, beating your internal goal by over 0.5%, that points to some deep efficiency gains.
It really does. But the real star of the show, the metric that often signals real financial health, was free cash flow, FCF.
And how did that look?
It was stellar. FCF hit $175 million. That is up 30% year over year.
30%.
And it wasn't a fluke. Management pointed to 2 key structural drivers. First, better cash from operations, so, better working capital management. And second, and I think this is more interesting, is their capital expenditure efficiency. They're using tech and better processes to run the business with less new capital. That's a huge shift away from the old heavy asset model.
Right, and that shift leads us directly to the big pivot. It's clear Brink's main growth engine isn't the armored trucks anymore. It's their high-margin subscription business. We're talking about AMS ATM Managed Services and DRS Digital Retail Solutions.
Exactly. This AMS DRS segment is what's changing the whole investment case for the company. It's high margin, it's sticky, it's recurring revenue. Organic revenue growth just in that segment accelerated to an impressive 19% this quarter.
To put that in perspective, the whole company grew 6%, but this one part grew 3 times faster.
Precisely. And the segment's getting bigger. It's now nearly 28% of their quarterly revenue. So the story isn't just growth, it's margin expansion driven by that favorable mix shift. The more AMS DRS they sell, the higher the company's overall margin goes.
Okay, let's talk strategy. How is management making sure this keeps going? I saw something about them aligning incentives.
Oh, that's a critical point. Management isn't just talking about this pivot, they're FIM. They are literally paying their people to make it happen. They expanded incentive compensation to over 1,000 employees, tying bonuses directly to how fast AMS DRS grows. That's a powerful cultural lever.
Sends a very clear message inside the company. Now looking forward, the CEO got pretty aggressive about their total addressable market, the TAM. He said they're still in the early stages. Something about the opportunity being 2 or 3 times their current size. That can sound like, classic CEO talk. What specifics did they give to back that up?
That's a fair challenge. They did ground it in 2 areas. One is the sheer number of retail locations globally that still just use basic cash in transit. And 2 is the huge ATM outsourcing opportunity, especially as banks are looking to get rid of non-core infrastructure. They're saying the market for managing cash is just vastly bigger than the market for just moving it.
And are they actually landing these big accounts, or is this still mostly theoretical?
No, they're executing. They pointed to broad acceleration everywhere, highlighting completed onboarding with major retailers. They mentioned QT and Racetrack in North America, Sainsbury's in Europe. It shows the model works for big global customers, which is key.
Okay, moving on from revenue, let's talk operational excellence. They kept bringing up something called the Brink's Business System, or BBS. What exactly is that, and how is it creating real, sustainable cost savings?
The BBS is basically their version of a continuous improvement system, like a lean manufacturing process, but for cash logistics. It's about using technology to make permanent structural changes to how they operate, not temporary cuts.
Can you give us a tangible example? How does that play out in the real world?
Sure. Think about their trucks. They're using predictive analytics to optimize routes. This means they can literally reduce the number of vehicles they need. So that's less fuel, less maintenance, fewer drivers to cover the same volume. They also talked about streamlining their back office admin expenses. It's about being smarter.
You can really see the results of that in North America. We saw, was it 320 basis points of EBITDA margin expansion year over year? It's a massive shift. Over 3 full percentage points of margin gain.
It just shows the discipline they have now, and they aren't stopping. They're now targeting at least a 20% EBITDA margin in North America over the midterm. That's a serious signal of their confidence in this system.
What I found fascinating was the link they made between efficiency and safety. You don't often hear that on an earnings call.
Absolutely. They reported a 33% reduction in their total recordable incident rate since 2023. And their argument is that better operations, better training, better routing means a safer workplace. And that, in turn, leads to higher productivity and happier customers, a virtuous cycle.
So if you connect all these improvements back to the balance sheet, how's their financial health looking?
Incredibly solid. Net leverage is down to 2.9 times EBITDA. That's important because it puts them right in their target range of 2 to 3 times, a little bit ahead of schedule. And hitting that goal gives them a lot of flexibility.
And what are they doing with that flexibility, specifically for shareholders?
They're being very disciplined. They've already used $154 million this year to buy back their own stock. That reduced the share count by about 5% so far this year, and those shares were bought at an average price of around $89.
So they're committed.
Very. Their stated plan is to allocate at least 50% of their free cash flow to shareholder returns, mainly through buybacks.
We know buybacks are a priority, but what about M&A? They can't just ignore growth.
They're not, but the focus has totally shifted. Management confirmed they are actively looking at bolt-on acquisitions, but specifically in software and managed services. They want to buy tech and capabilities to help AMS DRS grow faster, not just buy another armored truck company. It's very targeted.
All right, let's get to the Q&A section. This is where analysts try to poke holes in the story. The two big things seem to be the sustainability of margins and the impact of bank consolidation. How did management handle the question about bank branch closures?
Right. Analysts were worried that as banks merge and close branches, it's an automatic negative for Brinks. And management acknowledged that, yes, in the short term, branch closures could be a minor headwind for the old school cash and transit business.
But what's the long-term view? Is consolidation a net negative for them?
Management argues it's actually a net positive. When these huge banks merge, they are under immense pressure to find cost savings. And that need for efficiency actually speeds up the trend toward outsourcing things like ATM management. The newly merged bigger bank is more likely to hand that whole operation over to a specialist like Brinks. So consolidation is a long-term catalyst for their high-margin business.
And finally, guidance. Did they back all this confidence up with their outlook?
They did. They affirmed their full year 2025 framework, mid-single-digit organic growth, another 30 to 50 basis points of margin expansion, and strong 40 to 45% FCF conversion. The Q4 guidance also lined up perfectly with what the street was expecting. They're executing exactly as promised, which is really how you de-risk a story for investors.
Okay, now we arrive at our not financial advice segment. We have to say it again. We are analysts breaking down a call for informational and entertainment purposes only. We are not advising you to buy, sell, or hold any security.
Understood. But let's frame all this information as if we were making a detailed pitch to an investment committee, especially given that 7.5% pop on the day.
Right, lay out the thesis for us.
So the thesis is this. That 7.5% spike shows the market finally gets the quality of the recurring revenue from AMS DRS. However, the market has not yet fully priced in the compounding effect of two things. That sustained margin expansion from the BBS and the aggressive use of free cash flow to just keep shrinking the share count.
Explain why the buyback activity is such a strong valuation signal.
It's an explicit signal from management. The company spent $154 million buying back shares at an average price of about $89. So if the people who know the business best were aggressive buyers at $89, and now they're generating even more cash flow, then the current price, which is around $111, still looks very compelling, especially since they've promised to keep using half that growing cash flow on more buybacks. It just mechanically lifts EPS.
So based on that compounding cash and that implied floor price for management, what's the outrageous but plausible trade?
You execute a leveraged long position here. You target a 12-month price that's 15% to 20% higher than current levels. And this confidence isn't based on some hope for a market recovery. It's based on the visible compounding value created by their operational discipline being converted directly into shareholder returns.
A fascinating analysis, so let's wrap this up. The key takeaway from this deep dive is that Brinks is successfully pulling off a huge structural shift. They're moving from a legacy logistics business to a high-quality, cash-generating managed services model. The record margins and strong FCF prove it. It's a true metamorphosis story.
That structural shift is the core story for 2025, for sure. Now, for you, the listener, here's a provocative thought to leave you with. Management specifically said that AMS DRS penetration is still low in places like Latin America. You're talking about cash-heavy economies with huge fragmented retail networks. So the question is, with their new company-wide incentive plan, how quickly can they turn that focus into explosive customer wins and margin growth in those specific regions heading into 2026? Because if that Latin segment really ignites, that 2 to 3 times market opportunity suddenly looks very, very real.
Something to chew on indeed. That's all for the deep dive today. Thanks for joining us. We'll see you next time.